Hi Mr. Brown, I am Nick. Nice to meet you. I work with Liza in Public Finance Advisory. I believe you have certain clarifications on the financial model techniques used in public finance.
Hi Nick, I am Secretary from Finance Department. Yes, can you please run me through the flow of financial modeling technique? Sorry, we could not arrange a conference room. Need to manage the meeting here.
Sure, Mr. Brown. No problem, I will take you through the financial model techniques.
You look pretty. I love to see the young generation being aggressive in achieving heights.
Oh, thank you, sir. Thanks for the encouragement.
Okay, coming back to the financial model. Let's see how you start.
To start with, we take an Excel or spreadsheet. Then we create an input sheet, which differs for different projects.
Okay, Nick, what does it majorly include?
Talking about your project. Your smart city project falls under urban development. It would have various items, such as area of land, components to be built which are a hotel, a hospital, a school, residential buildings and a toll road along with utilities covering parks, water, street lighting, etc. There will be a concession period which includes construction period say 2 years and operation period say 30 years. I might explain the concession period.
Sure, please continue.
Operation period is when the project returns cash flows for meeting the capex incurred during construction period. Therefore, every year inflation is also considered.
Tell me, Nick, as government we are just giving the private player a land on lease for a concession period. Why should I be worried how much profit would a private player make? So why tears the need to make a model? Why not just take a cost of land based on market price which I am giving away?
This is a very interesting question. You need to first understand the concept of opportunity loss. If government is giving away the piece of land at a specific location for a long-term lease, it will lose the opportunity to build the facility. Means it is giving away the right to earn those profits. Also, price discovery is not an easy tool in government transaction. As concession period is different, location is different, output specs is different. However, when we do refer the prevailing prices in neighboring areas or transactions happened in similar area. Therefore, we create a financial model to analyze how much the project would earn, as reduced by expected return by developer. The remaining can be negotiated to be accrued to the government.
Okay, I completely get it, and then what's next?
To start with, we need to assess the project cost. This is done by estimating built-up area for each component. This is based on allowed floor space index. This is nothing but how high you can go above ground to utilize the covered area offered. Then multiply with cost of construction based on region-specific rates. You will get capital expenditure for each component. Please be mindful that you will have to convert the unit sizes in both area. And similarly cost to come at same base, say square meter or square feet.
Okay, I agree. After the area computation, what do you do?
Post this, we may derive at total project cost. This is total amount required to build all components. Then, we need to phase the capital expenditure in future years considering inflation.
Alright, I am very clear on CapEx part. What about any loan or debt raised during construction period? I believe the project will not have money to pay interest till the time operations start.
Yes, of course. Therefore, the lenders and banks allow to capitalize the interest during construction period. This means this interest cost will become part of project cost itself. And there could also be a moratorium period. This is a postponing payment of interest and principal allowed at the signing of loan agreement. Therefore, the longer the period of loan, the better it is. You may also note that in the Excel files, this function creates a circularity. That is, interest is derived from debt raised as a percentage of capex. However, the interest during construction itself becomes part of capex. Therefore, it is better either to switch on the iterative functionality in Excel or use a macro function.
That's true. What do you do next?
After this, we compute the revenue numbers. So, say in sale of a residential unit, we need to multiply the size of the unit with its price. Price discovery is in the way we discussed earlier. Alternatively, we can compute the price based on cost plus margin method. This means cost of the land attributable to specific unit plus construction cost plus margin for managing the unit. Note here that this profit margin is important as a developer would load the price with the cost of utilities.
Which utilities are you talking about here?
The utilities which cannot be allocated to one component. Let me give you an example. When you buy a house, you get free facilities, say a park, community hall and service road. These facilities will be used by everyone in your smart city. So residents, commercial occupants, school, etc. Therefore the costs are spread across all components and loaded on the final sale price.
Thanks, great. So start with replicating the techniques of financial modeling specific to our smart city project, which has a hotel, a hospital, a school, residential buildings and utilities. Also, I would reiterate for you that we are going to award construction of toll road with length of 200 kilometers outside the district. We strongly believe that majority of the traffic shall be the population residing in this smart city.
I got it. You may note here that the basic cost of construction and land shall be same for all components. That means the cost is based on area to be constructed, whereas land cost remains same. However, the revenue and cost drivers shall change for each component. Therefore, it is advised to create separate sheets for deriving profitability and return for each component. In your case, a hotel will have revenue from average room revenue per night, room service and other revenue. The cost for a hotel will be salary to chef, restaurant operating expenses, maintenance of hotel and marketing expenses. Now for a hospital, it will be revenue per bed per day, maybe some pharmacy revenue. The cost will be salary to doctors, maintenance of facility, management fee to an operator. So here you may note that hotel, hospitals, schools etc. may have different operator than the one who constructed it. This may be due to the reason that operators generally do not have a bandwidth to construct such a large-scale capital-intensive projects. Coming on to the next, the revenue driver for a school would be fee from students per year and revenue from sale of books, merchandise etc. The cost, however, would be salary to teachers, maintenance.
This is very interesting. Please take me through the drivers for residential and toll road.
Sure. Residential buildings envisages selling out housing units. The revenue should be the sale price per unit. There can be different size of units, say 2-bedroom set, 3-bedroom set or penthouse. The cost will be maintenance and marketing cost. Here you need to note that the sales might start even before complete construction. Therefore there could be elements such as advance from sales. For toll road, the revenue shall be toll collections with costs as salary and maintenance of toll structures. Here the capex is generally based on per kilometer. We discussed about loading of cost of utilities proportionately based on say area or percentage of usage.
So if after cost loading, if the final sale price becomes higher than market price?
Of course we need to be mindful of that. We need to put a cap on the sale price. However, developer may choose to charge higher if he is offering unique facilities. Say a spa or fitness center.
That's superb. It's crystal clear now. Then of course you might be consolidating all the components in some way.
Yes, we consolidate the net operating cash flows for all components at one place and evaluate if the project in total is making money or not. It may be possible that one component, say school, would not make much money as the fees are regulated by government. However, the same can be compensated by cash flows from other components when we combine the cash flows. We analyze all these to find return for a developer.
Excuse me. You are right. So what we get till now by subtracting operating expenses from operating revenues is earnings before depreciation, interest and tax, which is operating profit. Right? Please continue further.
That's absolutely correct. After deriving operating profit, we compute the non-operating expenses such as depreciation, interest, and tax. Depreciation is nothing but a percentage set aside every year for wear and tear of an asset. Every tangible asset barring land depreciates. The life of an asset decides the percentage of depreciation. You may refer to the asset-wise schedules of depreciation every country has.
You said set aside because depreciation is not a cash expense?
Yes, I used the word set aside as it is a non-cash item. This is relevant because authorities of each country allows this as a deduction from profits for computing tax. Apart from tax benefit, there is not much relevance of depreciation for financial modeling.
Okay, I was confused on this. Thanks for clarifying.
No problem. After this, we compute the interest expense on debt which we raised during the construction period. This is generally paid quarterly. For this expense also, one gets tax benefit. Therefore, the effective rate of interest comes down.
Again, please help me with an example.
For example, if the rate of interest is 10% and corporate income tax is 30%, the effective tax rate for the project is only 7%. Therefore, company prefers to raise more debt. Usually 70% of capex is allowed to be raised as debt. Remaining amount needs to be brought in as promoters' equity. Also, the catch is banks do not provide debt for purchasing land. Sometimes here, government gives mobilization advance to attract investors to expedite the timelines.
And last is the tax at a rate imposed by each country?
Yes, taxation is generally imposed as a specified percentage of profits before tax. This is computed on quarterly basis, however it is generally paid quarterly.
This of course must be a cash expense.
Yes, taxation is considered as a cash outflow. However, companies might choose to make a provision for tax amount. After all these, we make a profit and loss statement, balance sheet and cash flow statement.
Nick, it was a wonderful session. I think we should rush for the meeting with the governor, and in the next session we may discuss about the valuation techniques.
Sure, sir. See you.